I think those are the things to focus on, the dollar strength, certainly, and it's been how quickly the dollar has moved up as opposed to the dollar strength in general. I think that's the issue. It takes time for prices to readjust, for companies to readjust to higher input costs or lower input costs, depending on where you are in that. So it is disruptive. We've seen earnings come down significantly for the first quarter and the second quarter and probably the third quarter. And it's our view that dollar strength is just getting going, that we're kind of in the middle of this trend, and it could last for several years. So it's a focus. I think what do investors do about that, though, right? It means that equities are going to be a tough place to be an investor, but they're going to probably be a great place to be a trader, and that's one of our big themes for 2015. Is we thought this would be a trader's market and not an investor's market. Volatility has certainly picked up as there's a lot of tug of war between bulls and bears around some of these things, like the dollar, like the Fed, like the liftoff, a lot of things that are worrying investors. But at the same time, it just creates a lot of trading opportunities for guys like us who are out there trading in this market. And so I think that's the big thing for investors, to try to figure out ways to be much more nimble, much more proactive with capital, as opposed to what it's been like for the last 5 years, which is just the markets going straight up.
Okay, so if you're a trader that's thriving on volatility and you're looking at the equities, but then you also look at some of the data coming out and research coming out talking about the earnings season, Merrill Lynch is saying that a 10% increase in the dollar results in a $3 to $4 cut to full-year S&P 500 earnings per share. When you look at that, does that mean that you look outside of the U.S. markets and perhaps into Asia and European equities?
Oh, absolutely, and there are, but it's a theme in general. Like there are pockets of opportunities in Europe, certainly, and we're playing those. There are opportunities in Asia, but I think this is an environment where you have to be very careful about being disciplined to enter into those trades as opposed to long-term investments. And there will be times when it's great to be in them, and flows will catch up, and then have time to get out. So we are moving in our global allocation strategies capital into Europe. We've been doing very well in Asia with stocks there. But, you know, we're watching those valuation points and making sure that we don't get caught in situations that we don't like, because, you know, long term, this is about the developed markets actually becoming the fuel of growth here. Europe is going to be part of that. Japan is part of that. The U.S. is a big part of that. And so we want to stay close to home as far as that, but that doesn't mean that there's not a whole lot to do outside of the U.S. But we're very careful as a trader as opposed to a long-term investor.
Right. So you're saying it's a trader's market, not an investor's market, and really the volatility is going to continue until the Fed actually rips that Band-Aid off. With that in mind, Mark, I mean, what place do bonds have in portfolio in that kind of environment?
Well, bonds are going to have the same sort of volatility. Now, I'm not in this camp where we think we're going to have a huge problem with the liftoff. The liftoff is certainly on everybody's mind, and that's my comment about let's just rip the Band-Aid off. Let's get it over with. I don't think it's going to be an issue for the U.S. economy. I actually think it's going to be a positive. I think a liftoff would be something that assures people that the nuclear winter doesn't start, the world doesn't end, and then we get back to a lot of this capital that's on the sidelines that starts getting invested in the real economy. Now that again is something that we're looking for, but we're not going to get that for a while. So when people look at their bond portfolios, it's really a tough place to think about where you're going to be. There's a lot of crosswinds about where rates should be. There's a lot of debate about what's happening with capital flows in the longer end of the curve, and people much smarter than I are going to figure that out. And I really am not in the camp that I should be telling people what to do with that long-term interest rate risk. So we're finding places within the U.S. capital markets where we're exposed to a U.S. economy that's improving. Corporate health is very good, but we're picking up good yield, like 5 or 6%. Loans, bank loans are a good example of that, but MLPs are another interesting way to play it. You've got decent yields here because everyone's scared of the energy complex,